Welcome everyone. This is a session about the topic of dynamic cycle phasing. So this is extending the body of knowledge on the dynamic cycle explorer, especially for systematic trading. So the dynamic cycle explorer is a tool which is able to detect the dominant underlying cycle of price or sentiment movements and adjusting length, phase and amplitude setting according to the actual core parameters. So it's not dealing with static cycles, it's dealing with a dynamic component of cycles and is especially designed to detect the current cycle and progressing the current dominant cycle into the future to spot the main cyclic turning points. However, this session is not about the dynamic cycle explorer, which should be the starting before going into this presentation to understand the concept of dynamic cycles. This presentation is about phasing. So this is an important next step on how to successfully use the dynamic cycle explorer in trading. And what makes it so important is the dynamic cycle explorer is more a tool for analysis of dominant cycles and needs some validation approach afterwards. So, and the phasing approach, which is now put it on top of the cycle explorer, makes it more systematic and therefore more objective to tweak out the trade decisions afterwards. So first of all, let's recap the dynamic cycle explorer in general. It was published in the year of 2010-2009 in my first publication on dynamic cycles. So it's a technique which is already there for over 5 years now in the market. And each year I've presented, 3 to 4 forecasts live and ahead of time with this toolkit. So there's a lot of validation out there where I've provided cyclic forecasts based on these technique which have played out right on time. So I don't go into the details of the Cycle Explorer, but just to remember, the Cycle Explorer detects the underlying dominant cycle within a given price series, for here as an example, is then plotting the theoretical cycle here as dotted line against the filtered price swings out of the real data to compare if the price is in vibration with this cycle. It then adjusts the cycle according to the current situation, not on the best fit on the static here with the past. So the current situation is important for today's analysis, and then is able to plot these cycle into the future, then to check what is the current situation out of this forecast and see what to expect to move forward. There's a lot of information on these technique out there, so I just recommend visit the website. There's a lot of free articles out there which explain these technique here. So the Dynamic Cycle Explorer is a very powerful technique in detecting the current active cycle in the market. But let's move forward, and we want something in addition on that, because often markets are not only driven by one dominant cycle. So there are a lot of cycles active in the market, and they interfere with news-driven price movements and a lot of other topics. So one dominant cycle is very important, but you should not rely your trading on one dominant cycle. So therefore, it's important that we get an objective technique or just a systematic approach how to validate if a cyclic forecast or situation is valid or not. And this is what I want to talk about now. So if we think about the cycle parameter in general, we have to keep in mind that just the perfect cycle looks like this in the base on the phase information and amplitude. This is just a standard cycle here. So keep in mind we have a length setting which describes the distance between one top or one low and the next low, or one high and the expected next high. So this is the length setting of a cycle. We then have a given amplitude on each cycle, which describes how high or how low the cycle will move. And we have the phasing information, and the phase information gives you the information where the cycle is at the current point in time. So the phase angle, this is a very technical term, but we will come to this later, is derived from this rotation and then plotted as the cycle in degrees, the phase angle here on the chart. So, and the phase is the third important parameter for each cycle, which gives you the information where we are in this cycle here based on the phi. So we have the length, we have the amplitude, and we have the phase, which gives you the information where we are in the cycle. These three parameters define each cycle. But however, each cycle has three different parameters for length, amplitude, and phase. And on top of that, they vary over time. So no cycle stays static over the whole time. And this is the special benefit of the Dynamic Cycle Explorer, because the Dynamic Cycle Explorer is exactly able to cover these three parameters in real time for the current situation, which is important here. So just to make this a little bit more visual, if we have two cycles in action, or we say there's one dominant cycle, but however there are more cycles which interfere with the dominant cycle, you will observe a situation where the phases are not in alignment for each cycle. So in the real market, it looks like these cycles are active here, shown in the upper area. Yeah, the green is one cycle, and the phase information is here going in circles. So this is the phase of the first cycle, and this is the second cycle with a different length and a different phase setting here. So, and in the lower window, you see the combined output of these waves, or the superposition waves, based on the two cycles shown in the above panel here. And if we just have a look at the important points, so I will just stop it here. When you see when the both cycles are in alignment regarding their phase, so both phases point to a low here, you will see that the combined effect is also a major low. On the other hand, if you see that the two phases for these both cycles are out of sync, so the one cycle is has a top current condition here and the other cycle has a low condition here, the combined wave will signal a zero here. So they erase each other. So there will no turning point in the combined wave here. And this is what happened often in real time, especially when you don't know regarding the dynamic amplitude. So sometimes you have a smaller cycle, which in general has a small amplitude, but based on the dynamic component, the amplitude can grow, and therefore even a smaller cycle can erase a larger dominant cycle here if the phases are not in alignment here. So if you just track one dominant cycle here and think about up top here at this point in time, this will be erased by the other cycle, which just has the other phase around, which gives you a neutral situation in the market here. So, and this is what makes the Dynamic Cycle Explorer tricky if you just follow one dominant cycle, because for sure there will be other cycles. So the phasing component of these cycles are very important, and the phasing component of other active cycles is especially important when you judge one dominant cycle, which has been detected by the Dynamic Cycle Explorer. Therefore, what we can do is we can divide our, let's call it perfect cycle, in so-called segments. So to make it more subjective and mechanical, what I've done here, so this is the full cycle turn, and I've divided it into 16 different segments here. So if we want to judge cycle situations, it's just important for us in which of these 16 segments is the cycle currently at the point of our analysis. So we are not interested in the real value because cycle projections don't match exactly at the bar or at the day. But however, if we know in which segment the cycle is, this would be a very good information here. So for example, the bottoms in regarding the price series is allowed in this area here. So the segment 3, the segment 4, the segment 5, and the segment 6 would be good points regarding the phase information when we could expect a cycle bottom and then corresponding to a price bottom, for example, here. So it's important to see if the cycle is in one out of these 4 segments or not. And you can give them numbers. So we start with the downtrend neutral here. These 2 segments belong to a neutral downtrend segment. And then the segment 3 is an approaching bottom. I've given them descriptions here. So the segment 3 is called approaching a bottom with a score here. And then the scores go even higher just when we arrive at the bottom arrival segment. Segment 4 and segment 5 is the bottom departure segment, which has the highest score here. And then we will start with an uptrend here in this segment, which is also the bottoming area, but starting an uptrend here. So, and these are the values assigned to these segments here. And then once the uptrend is starting, we go into an uptrend phase, a neutral uptrend phase, with this area belongs to the neutral uptrend. We have then the values of 30, 40, 50, and 60. So positive values once we start with an uptrend here. And then the other way around, this segment 11 here is the approaching top segment, which we have a score of 80. Then the next segment 12 is aligned to the top arrival segment here of the cycle, 95 score. And the top departure is then the 100-point score here in segment 13. Segment 14 is then the downtrend starting area with this information here. And then in segment 15, the downtrend starts. So we start here with negative values again. So we have a downtrend neutral, which start here with minus 30, minus 40, which then continues with minus 50, minus 60, and then it begins with approaching the bottom here. So this makes it more readable. So instead of dealing with these technical terms like phase and phi and RP and all these mathematical and technical terms, which have to be taken into account from a mathematical point in the background, but however, now to make it more visual, to make it more understandable from a trader's perspective, I will use these 16 segments with these clear areas described here with these words, and then assigning them special scores. So and once we've defined our segments here from the cycle, then if we're talking about phasing, we're not interested in length settings or in amplitude. We're just interested in which segment the current dynamic cycle is, because this will be a major information on how to derive our trade decisions here. So, and especially the green marked areas and the red marked 4 segments are the interesting ones. And if we assign them numbers, we are able to deal with them on the chart afterwards. So this is a very important picture here to understand the concept of phasing later on if we just see the numbers and segments after all. So you have to keep this in mind. This is the most important information, how this phase information is coded into tradable information. So this is one cycle. And as you're aware, the Dynamic Cycle Explorer tool, you have 2 presets. So and in my first book, I explained it makes sense to talk about a short-term cycle and a long-term cycle. And we will just use these 2 presets here. The short-term one defines a range to detect the current dominant short-term cycle, and the long-term, as the name says, gives you the range out of the long-term cycle here. All other parameters are stayed fixed. And what the phasing approach now is doing, it automatically calculates the current Dynamic Cycle Explorer for the short-term cycle and for the long-term cycle by selecting the anchor date automatically, so there's no parameter. This tool, or the phasing tool, now just uses 2 Dynamic Cycle Explorers. So the phasing component, which I will now introduce to you, are just 2 Dynamic Cycle Explorers run in the background. And these 2 Cycle Explorers just pull out the current phase segments out of these two dynamic cycles here. And we will deal with this information afterwards. So it's completely automatic. It's completely using the algorithm introduced in the year of 2009 about the dynamic cycles. The whole algorithm has not been changed. It has just been made more automatic or systematic. So the anchor date is selected automatically. So there's no parameter which has to be entered, fixed, or back-tested, or curve-fitted, or whatever. So the phasing approach now uses the two dynamic cycle explorer algorithms in the background, calculated automatically. So what comes out, just in general, to move forward how? Now there are some cases here to explain the scoring algorithm in the background. I've introduced the concept of using phase segments here. So here are 4 examples. Let's start with the first one. So this is the detected long-term cycle. Which this is the current point in time, so today, and this is the future, and this is the detected short-term cycle here. And what you see here is that the long-term cycle is signaling a topping condition, and the short-term cycle is signaling a bottom condition here. So I mean, it's quite easy, but from our scoring algorithm here, you know that this situation will get 90 or 100 points plus, and a low situation will get minus 100 points. So the combined phasing score will be a 0 in this case. So let's move to the other extreme, or to the other example. Here we have also the same long-term dominant cycle as we had before. So the short-term cycle now has a different phase and length, and has also passed the topping area. So here we get a total phasing score of 100 points, or 100 points and 95 points. So we have a total phasing score of 195 in this situation here. So the third example is just another example here. So here you see the detected long-term cycle, which is just in the middle of a downturn. And we have this shorter term cycle here, which is just in the middle of an uptrend here. So, and these also neutralize themselves. So this is a minus 50 points, and this is a plus 50 points, which sums up to 0. So this is the same combined cycle situation here in these two instances here. And the fourth example here, this is the long-term cycle, which is in a running uptrend here, in the middle of a running uptrend, and this is the short-term cycle, which is also around the middle in a running uptrend here, and which totals to a phasing score of 100. So and here, if we just rate these 4 instances, there would be only one instance which makes a forecast interesting for trading. So we would not trade the first one, as we have 2 diverging cycles, which in general would point to a neutral situation here. So when the Dynamic Cycle Explorer detects this possible situation, it's important to detect the short-term cycle, and even if it has a lower amplitude, regarding the phase information, it would give us an indication no valid time to put some trades out of this information here. And the same is in the third situation, as in middle of an uptrend and downtrend, is just also a 0 score. And even these in the middle of the uptrend here would give us no valid trade information based on the cycles, even if it has a higher scoring here of 100, and the best score and the highest score is, of course, if these 2 cycle alignments here are in place. But however, now we transform this visual information out of cycles, which you normally analyze with the Cycle Explorer on the chart, is now moved into mathematical terms to make this analysis more systematic and objective here. So this is what the phasing score is about. Let's just review the next 4 examples here. So in this example, we have a long-term cycle which is nearing the bottoming area, and we have a short-term cycle which just leaves the bottoming area. In this situation, this is minus 95 points. This is also minus 95 points, which totals to minus 180 points. So the second example here on the second page is that we have the same long-term dominant cycle, which is nearing a bottoming area here. However, the short-term cycle has just approached the top and is now leaving the top. So, and it's more far away from the bottoming area here. So there we have, I think, these minus 95 burns plus a starting downtrend, so plus minus 30, which is a total of minus 110. So the points are derived from the first chart, which I just introduced some slides before. So it's important to have this slide in the back to know how to calculate the phasing score here. Okay, so this is the second example here. So another example here, we have the long term is bottoming currently, and the short term cycle is then here in the middle of an uptrend here. So we have here the minus 100 point, but the middle of an uptrend gets plus 50 points. So in total we have minus 44. And just the last example here. Here we have leaving the bottoming area and the long-term dynamic cycle and just arriving at the bottom area of the short-term cycle here, which gives a total of minus 155. So on these four instances here, we have two situations which would have been valid for trade decision making. It's the first one and the last one here. So the other two would not give us valid information to trading, even if the dominant cycle shows a current situation here. So okay, this is the concept of dynamic cycle phasing and building scores out of the current dynamic cycle, or the two dynamic cycles which are active in the market. But instead of exploring this information visually on the price chart, which is mainly the dynamic cycle explorer is about, now we put it into an objective score. And let's see now what to do with this score. Let's start now with some examples on how this looks on the price chart here. I've coded this into one new separate indicator. So it's a fully automatic indicator which builds just the two dynamic cycle explorer in the back. So you don't have to do it manually to put on a long-term and short-term dynamic cycle explorer. This is what the tool will do. It will pull out the cycle phase information, get the cycle scores, and build the component cycle phase score. So even if it looks like an indicator, it's based on two dynamic cycles in the background. That's important to understand, because if you look at it visually now and then on the next chart, you will just see an oscillator. However, it's not about a new just oscillator as indicator. This oscillator is based on two dynamic cycles. So it was important for me to just explain this concept first. So let's start with the S&P 500 daily chart, which is just plotted here on a daily basis. And just here below, you now see the cycle phase information as I've explained before. So the values can vary from plus 200 down to minus 200. So these are the extreme scores where the phases are in alignment here. And now you see this is the phasing indicator, which is based on the two dynamic cycle explorers here in the back end. So I've just marked the extreme situation. We have learned that values above 150 would indicate that the short-term and long-term cycle are in alignment regarding the phasing, and the value below minus 150 would indicate that also the two cycles are in alignment regarding the phase information, indicating a bottom. So what we've done here is we have marked each instance where the phasing indicator reached their extremes below the 150 or above the 150, and marked it now with green and red arrows on the chart. Yeah, now it gets interesting if we just inspect this chart visually first, just starting. You see once the indicator reached the low value below the extreme, this corresponds perfectly to this low here, and you see the next one then here when it reached above the 150. This exactly is synced with the market top here, so we can move on, and it's just marked on the chart that each situation here it's touching the minus 150 and exactly corresponds with this low here. Then we move forward in time, so here's the next instance exactly where it touched below the 150. This is this low here, so another low is here. When we have this spike in the dynamic cycle phase alignment, it's exactly aligned with this low here. So then this top here is exactly synced with this situation when we touched above the 150. So you see that, yeah, it looks like an oscillator, but it's not. It's two dynamic cycle explorers with the phase information here on the chart. It's just presented in a way which makes it readable for a trader, or just to add now systematic trading approaches on top of that. So, and what's really outstanding is that the precision on how these cycle phase information from the dynamic cycle tool set is able to catch the market pivots here. So, I mean, these are very sharp signals here in the market. If you are aware of these oscillator indicators, like a relative strength index, you know that they can stay for a very long period above or below or above a threshold line. But what you see here is that you have clear, sharp indications here on the turns. So there's not a long period of time and you don't know when market will turns. These peaks are very precise and sharp and aligned to the market information here. So this is just a period of about 1 or 2 weeks where this happened here, and this is exactly aligned to this market low here. And you can just move forward in time and you will see that this market top here with this precise peak here of 2 or 3 days from the dynamic cycle explorer just gives you very precise cycle information here. So, and you can review the chart on your own, so I will not go over each instance here, but I think it should clearly pop into your eyes that these are very, very sharp and precise turns above the bands. So, and all turns above or below, below or above these threshold lines correspond then really to market turns. So each instance is marked here by a blue line. So it's not just marking the ones which have worked, it's marking all ones on the chart here so that you can inspect and check it afterwards. So and this is the important concept of dynamic cycles. So you don't see an theoretical swing here as you would expect from static cycles. You see that it's jumping up and down, but not on price information, based on two dynamic cycles which are active in the market here. And they are what we're looking for, the points in time where both active cycles are in alignment with their phasing information. That's the important time. So, and this is now the information on top of just one dynamic cycle explorer. One dynamic cycle explorer will visually tell you where one dynamic cycle is. And I mean, you can decode this information, and I think this is what I've shown during the last 5 years in a lot of live examples, how to do that. But even if you want to have it systematic, this is the way to go, and this is the way to read this information here. So if we just now go into the statistics and analyze these more technically, we have 52 dynamic side facing signals over this period, about 7 years, when I've put this chart on here. So and 43 out of these signals occurred exactly on turning points, market pivots here. So, and we have a total of 9 signals which have been false signals. So I've marked them also here on the chart. So to be honest, for sure, not every signal is correct. So these are the ones here with the arrows here marked, which would not have given us a valuable signal here. So for example, this top information, it was no market top. This cycle low information here was no cycle low. Even this was not a top. Or this was not a correct low, this was not a real market high here. So I've marked fairly these instances here to be fair and to be real. There we have nine signals from the phasing component, which would not have given us valuable information. But if you total this, you have 9 signals out of 52, which gives us a confidence of about 80% of these signals are exactly aligned with market signals, and this is the very high range. For sure, this is just one market, but it's the first point in time I want to introduce this concept to you, and now let's move forward. So these are price cycles. Here, the cycle phasing indicator was aligned to the original Standard & Poor's 500 index price information here. For sure, you can use the dynamic cycle concept on other data, for example, on social media sentiment cycles. So, as you know, we are a huge fan of providing or putting cycle analysis on sentiment information. And one provider of sentiment data is PsychSignal. They provide social media sentiment data, which is harvested out of social media conversations in real time on the web, and which is a very interesting raw sentiment information. And therefore, it's a good idea to put the Dynamic Cycle Explorer on this data set. And on top of that, we can not only use the Dynamic Cycle Explorer, we can also put our phasing approach here on this data set. So let's review a silver example here. This is the silver futures price chart for the last, I think, 2.5 years. Put on the chart here, and in the lower window, I've loaded up the PsychSignal sentiment information here for the silver ETF data, which is available here. So this is the raw sentiment data provided by PsychSignal. For sure, the raw data is hard to read or hard to put information out of it. So you need to know what to do with this kind of data. But one way to deal with this data is to put the cycles on. And I've provided some examples on using the Dynamic Cycle Explorer, and in this example here we will add now our cycle phasing indicator, which is now the same, putting two Dynamic Cycle Explorers on the chart, a long-term one and a short-term one, which fully automatic anchoring, no individual parameter, so there's no parameter setting which is designed for a market or something like this. This is pure cycle detection in the back end, and just putting a phasing score out of it and displaying this as an indicator. This is what you see here down below. And now we have the same concept. We look at the extremes above 150 and below 150, which are in alignment with phasing alignments. So now we will highlight it on the chart again here. So again, each job above or below are now marked on the chart here with these arrows. And to make it clearly readable, they are assigned here which lines, that you can see that they are really assigned up to the point here again on the chart. And for sure we have some false signals here also, so this would have been a false or just a very short-term pop here, but we would call this a false signal here to be fair with ourselves. But however, you see a similar information as we have seen with the price cycles here. So the extreme readings here correspond to really good price turns. And now you have to keep in mind that these cycles detected here down below have nothing to do with price. So this is social sentiment data, which is then put into cyclic analysis here in this panel. So this lower panel has nothing to do with the price data here. So it's very interesting that these phase alignments just correspond to the market tops here. And I mean, you have the same information here. There are very sharp situations here with clear turns. So there are no long periods when this indicator stays above or below this level here. You see you have a clear indication when it's above the threshold level, and this corresponds to market pivots here. So this is what makes this phasing approach very interesting. And the phasing, this is what you have to keep in mind, is based on the Dynamic Cycle Explorer on the back end here. So even these lows here, these are no real individual signals. I mean, even if they are in alignment with the market low, but would not rate them as tradable here. So, but the last one which came in here just was very interesting here. Then even maybe you could count this at the market top, but from a short-term perspective, market did not move down, so we will not count this as a market pivot. So we are very critical here with our own indicator. So this is not a valid signal here, even if it popped up and was a market high for a long time. We don't count it as a valid signal. The next valid signal came in here, and then the downturn started, and then we have these two bottoming instances here, and then the next topping instance here, clearly indicating the market top here. So in this chart here, over 2 years of silver futures with the social sentiment phasing approach here, we have 21 out of 28 signals which are in alignment with turning points on the market, and 7 signals out of 28, which is a score of 25%, which have been false signals. So here we have a confidence of about 74% that these cycle phase indicator scores correspond with market turns. Let's move on to another third example here. Let's go to Apple and use the same approach. We will use social media sentiment data provided by PsychSignal here, and apply the same analysis. So here's the Apple price chart. Down below you see the sentiment data provided by PsychSignal in the raw format here. So again, we will now attach the cyclic approach. This is the cycle phasing indicator here, same as before. No market relevant parameters, no parameter tuning, no back testing, optimization, so what. And now we will mark again the turning points here. In the extreme situation, the same areas are used above 150 and below 100, minus 150. So these peaks are then now corresponded to or marked on the chart. And as you can see also here on this Apple chart, it's very interesting that this information is again synced with market pivots. I mean, and it's the same information as in the two examples just before. You have very clear and sharp signals when you have the phase alignment here, and these phase alignment is directly linked with market pivots here. So here is the top or down pivot here. So you can see that most situations are clearly indicated with these sharp reversals here. So we can just highlight it on a chart to make it more visually. You see here that mainly all turns are corresponded exactly at the point in time where we reach the phase alignment here. So for sure we have also false signals here to be critical with our own analysis. But again, here we have 30 signals in total over the last 2.5 years. 26 out of 30 signals have been exactly on time with price turning points, and 14 signals out of these 30, 4 signals out of these 30 have been false signals here. So again, we have a confidence score with around 80% on when these cyclic phasing indicator extremes correspond to market turns. So this is a very interesting research results which can be used in addition to the dynamic cycle explorer in general. So now you are able to use the dynamic cycle explorer in general to get a feeling where you are in the cycle, what is the dominant cycle length, where are you in the current cycle. But however, it's not easy to derive trading information just based on one dominant cycle. So now you have a very objective phasing score, which is no fancy price oscillator calculation. This is just pure cycle work. It's purely crunching the phasing information out on the two dynamic cycles on the market and putting them on the chart, and it gives you a very easy readability information when the phase of the two dynamic cycles are in alignment. And I think, as you have seen out of this presentation, that these are the points in time when you would expect the market to turn. So just to put this into a summary, we have learned that we get about 80% confidence for a market pivot, which follows a price move above 5% if the cycle phasing score is above 150 or below minus 150. And this is the same reading as if we have two dynamic long and short-term cycles in top or bottom phase alignment, but however now made into a systematic indicator approach. So as I have explained, you can use the Dynamic Cycle Explorer to detect the current dominant cycle as presented in book part 1, or by the tools you can use to detect this dominant cycle. And if the Dynamic Cycle Explorer shows a topping or bottoming situation, now we can cross-check the dynamic phasing score to get a systematic and objective approach out of that. Yeah, that's it. That's the next level on dynamic cycle trading and our latest developments, which will be shortly moved into our tool set. So thanks for listening, and let's discuss this in our learning area. Thanks for listening.